So obviously after last year's painful sell-off in terms of fixed income markets, we're more optimistic in terms of its prospects and going forwards. In fact, we're quite bullish in terms of fixed income. We believe that heading towards a slowdown into a contraction phase, we believe that this stagflation transitioning into a stagnation type backdrop will be conducive for high quality assets, especially those which are sensitive to duration. So we believe that in going forwards, the prospects in terms of bonds are more bullish than what they were in the past. So as a result, we think that the income has returned in fixed income. No longer do we need to actually chase yield by going down the credit quality spectrum into high yield. We can actually find attractive yields in IG corporate bonds. So we think all-in yields in this environment for this asset class is very attractive. In fact, as investors of fixed income, we also need to remember that for this asset class to perform, we don't actually need to see a strong market rally. In fact, income is also quite a key contributor of our overall return. But if there were a couple of catalysts to see further gains, we would say that it will come from two sources. One is from a technical perspective. For example, in various pension markets across the UK, US and across Europe, what we're seeing is that the pension funded levels of most of these schemes are now above 100, which means that we're seeing a lot of de-risking appetite away from equities and into bonds, which are providing a technical support for the asset class. And secondly, I guess given where level of rates are in terms of how much various central banks have hiked in this cycle, there's definitely ammunitions to cut and see a strong rally in terms of generated returns as a result of where the level of rates are. So we do believe that there's an advantage in terms of both income as well as compression from a technical as well as from a valuation perspective. So we do believe that the silver lining as a result of this repricing of rates, valuations, in our opinion, are the most attractive it's been since the global financial crisis. So whilst we wouldn't say that this is a once-in-a-lifetime opportunity for this asset class, we do believe that it's a once-in-a-generation opportunity to actually add value through buying defensive fixed income products, asset classes in global IG. So whilst there's concerns in terms of higher rates risk, we believe that current valuations is able to offer a buffer towards higher interest rates because of the yield or carry component. But as investors of this asset class, we cannot just look at what the market will provide from just the index alone. We think that there's also many dispersion opportunities within this asset class, be it looking at across the capital structure, where we find subordinated debt more attractive than senior, on a regional basis, where we find Europe, UK more attractive compared to US, as well as on a sector basis, where financials is more preferable to non-financials. So as we head towards this end cycle where we see slowdown and contraction, we expect to see investment grade outperform high yield. So we have a bit of a decompression approach. The reason why is that to head towards a contraction type environment, typically what we see is growth to impact various asset classes more. And I think that high yield is more impacted by weakening growth compared to IG. What's more, a couple of reasons why we're concerned in terms of the high yield market, and maybe less so in the IG, is fundamental related as well as valuations related. Fundamentals from a perspective whereby about a few years ago, high yield issuers were able to tap into the high yield market and actually issue bonds around 2 to 4%, which are very low. Fast forward present day, they actually need to refinance themselves again, and obviously the interest rate backdrop is quite high. So we're reaching a refinancing maturity wall, which is more sensitive for high yield issuers. But secondly, from a valuation / fundamental perspective, as credit investors, in order for us to invest in the asset class, we want to be compensated for the risk that we take in credit. Now, when we look at the spreads and the default that it implies in terms of IG compared to worst case and I guess average historic default rates, we think we're more compensated. However, in high yield, it is less so. So we think that from a valuations angle, high yield is more prone to downside versus IG. So our allocation strategy into the next cycle can be summarized by playing defensive. So we like to go up in quality in terms of what we have in our portfolios. But we're also value orientated, and we see a lot of relative value opportunities. But having said that, we also differentiate in terms of sectors which are more rate and growth sensitive. So what do we like? Well, we're taking a bit of a barbell approach from a maturity perspective, in the sense that we like long end credit. So we're happy to invest in high quality, long end dollar credit, where we see the income around 6.5% as quite attractive. But we also are invested in short end subordinated callable bond paper, which is offering 7 to 8% in terms of yields. But sector-wise, we also like financials. We think that the balance sheet is quite strong, and also energy sectors, where we have a net zero decarbonisation theme that we have in the funds. But also from a regional perspective, we like UK credit, given the de-risking activity that we've been seeing through a lot of pension funds. Areas of the market we're more concerned about, and hence underweighting in terms of our portfolios, has been in more cyclical sectors, lower down in quality, as well as in markets or sectors where it's more rate and growth sensitive. So these are REITs and consumer discretionary sectors.